Okay, so good morning, everyone. Welcome to today's macro snapshot. I'm recording this on the morning of Monday, January the 13th, 2025. Obviously, what the market is trying to figure out probably is just still dealing with the reaction to the very strong non-farm payroll numbers, which we had last Friday. Essentially, the numbers were strong, although you could say that the average hourly earnings were not necessarily too troubling. But clearly, what's happening is that the US has a strong economy, at least as reflected in the labor market. Now, the big event of the week, if we just look forward a little bit, we do have some earnings starting to come up. We have some of the big banks reporting this week. But really, probably the big one is just highlighted here is the US CPI, which is going to be Wednesday, obviously, in the morning. And really, what the market is trying to say is like, okay, if the economy is very, very strong, there's potentially inflationary pressures coming through, from potential Trump tariffs. And if the CPI comes in a little bit hot, not only can the Fed definitely not cut and probably stay on pause, but is there a chance at all? Under what conditions could we get the Fed actually hiking? So that's something which we'll be looking at. So other interesting things here, we have a speech tonight, which I'll get into in a second, from the BOJ's Himino. At about 8:30 or so. Now that's well, we'll get into that. It's interesting. We also have there's some gilt auctions here. You see for the UK bonds, which have obviously been under a lot of pressure recently. We get a bit more sort of inflation data in the US. We get PPI, and we get some retail sales and a bit of Fed speak, as well as the Aussie jobs. So that's probably the highlights of the week, but definitely is going to be the US CPI. So let's just look now and see just how the market did actually react. And I want to look at sort of the bigger picture, just in terms of, from the Fed where we are. It's Monday morning. So what I've got up here, guys, this is just the SOFR curve, so the short-term interest rate curve. And what you can see, that's actually not gas, so that's not the one you want. Here's the SOFR curve. So here's the SOFR curve here, which is the live data, and you can see here the implied yield over on the right here. So basically, what the market, is saying at the moment is that the Fed, it's going to get to a lower cutting cycle at the end of this year, which will be down at about 4.11%. So you think about it, that's a terminal rate of over 4%, which is very, very different. I mean, we'll go back, 6 months ago, just to put this into context. And you can see that 6 months ago, the lowest point was down at 3.5%, which you can see down here. But probably more to the point, though, let's just have a look and see what's happened over the last week. And this reflects the change between the non-farm payrolls. You can see that these orange bars down here is the amount of basis points which has been repriced hawkishly. So what you can see is that the market repriced by about, depending on the contract, 10 to 15 basis points. And we now have, you can see here that the orange line here was basically where we were a week ago, and you can see that the lowest rate, so to speak, has been priced upwards, so pretty hawkishly. So let's say we look at the so-called sort of terminal rate, about 4%. That's now gone up, as I said, to about 4.12%. So that's half a cut. So if we actually then look at something here, I mean, what is the market basically saying? And it's pretty incredible to think that only I think back in September, the market was pricing in almost 10 full cuts, 10 cuts. By the end of this year. So a pretty aggressive Fed, very dovishly. But if we now look and see what's happening, we can see that the first cut, this is the implied rate of change. This is in basis points. So keep in mind that one cut would be 25. And we have to go all the way down to, I mean, technically sort of October or even December 24 to 26 for the first cut. So we've gone from a situation where essentially the market and the Fed was expecting a slowdown, or at least the Fed to have some kind of cutting cycle. But we can see now that after the Fed has cut 100 basis points, the market is essentially saying, well, okay, that seems to be basically it. We may get one cut at the very end of 2025 this year. And when's the second cut? We don't even seem to have two cuts priced in at this point. So even if I go down a little bit, the maximum we get to is about 1.8 cuts all the way at the end of 2026. So really what's going on at the moment is that the market seems to be saying that the economy is strong, the employment situation is very strong, inflation seems to be a little bit sticky. So let's just actually have a look at that. I think I pulled it up. Because what I want to pull up here is, do I actually have that? just want to look at the inflation swaps and just see whether the market is actually sort of talking, is thinking that inflation is going up. So this is the inflation swap curve. So this is market-based measures of inflation. And you can see here we have the tenors down the bottom, so 1, 2 years all the way out to the long term. And you can see at the moment that, that's where it is. But if we go back, let's say from one week ago, which we'll do, and this is where we were 1 week ago. So you can see that all across the curve in the inflation swaps, inflation expectations as priced by the market have gone up. And you can see, especially for the next year or two, they've gone up 14 to 15 basis points, so 0.14, 0.15. So it seems as though the market is slowly sort of thinking, rethinking its stance on inflation. If we actually then look at the whole sort of inflation swap, no, actually that, right. Here we go. So all the inflation swaps across all of the different tenors here. This will give us a good sense. So this is a daily chart, and all of these different sort of squiggly lines here are showing us the different tenors. So we have the white is the 1 year going all the way out to the 30 year. And essentially what you guys can see here is that if we go back to, let's say, August, September, inflation, was considered to be, sort of coming down and certainly pretty anchored around about 2.2%. But at least according to the market here, what you guys can observe is that over the last 2 to 3 months, we have gone up. And then after it's stabilized a little bit, it looks as though over the last sort of few days, the market is now starting to price an upward curve. And this is not welcome news for the Fed. And so if you then sort of consider that, maybe Trump's going to do some deregulation, some tax cuts for corporations, maybe some tariffs, which could be inflationary, you have to be thinking that the Fed might be starting to get a bit worried about achieving their sort of inflation goal. Now, a lot of people are saying that the Fed's de facto inflation goal is probably at this point more like 2.5 or 3%, but they cannot openly state that, and they will publicly continue to say that they only want a 2%. But the point is that it seems unlikely that we'll get sort of many sort of cuts, at least in the next 3, 4, 5, 6 months, unless data starts to disappoint. And some market commentators are saying that. So really, and what's more probable is that we have a Fed perhaps sort of on hold. Now, if the data does start to weaken, could we be faced then with a paradoxical situation of a Fed which is so scared of cutting and getting it wrong that they actually remain a little bit overly restrictive? We shall see. In the meantime, what the market's trying to figure out is really, with these yields going up, and let's just look at the bond market reaction. With the yields going up, and we know the yields have been going up a lot over the last, sort of month or so. So at what point will that impact dramatically other risk assets? And we are starting to see that in stocks a little bit. But let's just have a look. It's kind of interesting to me if we look at what happened on Friday after the non-farm payrolls. Here's the 2-year yield, which historically has been fairly tied to the Fed funds rate. And we can see that that's been going up for a long time, but we had quite a big reaction on Friday, which is normal. We had, as the market repriced the Fed sort of cutting less essentially, and later. But what's interesting, there's the 2-year, but look at the 5-year. The 5-year yield actually went up a lot more. And then we go out to the 10, not quite as much, and then 30, actually not that much at all. And even as we see today, it's a bit of a red candle. So the point is here is that if we go back to Friday, we see that the 5-year yield was actually the one which was the most affected, not the long end yield. So I just want to make a couple of points there. Why wasn't the long end yields that affected? Because everyone says, oh, inflation's going up and the long end yield will suffer the most for that. And that is true. And we do also have a strong economy. But it seems to me that although inflation expectations are rising a little bit and the economy is strong, remember that if the market believes that the Fed is going to not cut interest rates, that technically is not bad news. It's like sort of the doctor coming in and giving medicine for the long end of the yield. So interesting there that the long end of the yield didn't do too badly at all, the 10 and even the 30. And really the one was the 5-year yield, which took a lot of the pain rather than the 2. So what's basically happening is that the market's saying, okay, the Fed might be a little bit sort of on pause at the very front of the curve, but that means that it's pushing out the rate cuts. And that's why that 5-year is kind of like the pivot around which everything is sort of focused at the moment. So let's keep an eye on the 5-year. The other thing which is interesting is also you can see that revealed a little bit in the yield curve. So if we look at some of the yield curves here, we had weakness at the front end. Now, of course, that means that let's say like the 2 and the 30, we see that there was like a pretty nasty bear flattening. So we saw that the yields at the front end went up a lot more than yields at the back end, which caused the flattening here. And that's so we see that in the twos and the 30s. And if we look at, let's say, the two to the 10-year, we also see some flattening. But what's quite interesting is that if you look at the 530, so look at the 230. This is the flattening. Then if you look at the 530, you see that there was an even more aggressive flattening. So again, what that's telling us is that really that the pain was felt in the 5-year, and that's the one the market thought was a little bit overpriced. And then again, if we look at a couple of the other ones, if we look at the twos to threes, we see that they actually steepened. So that's quite interesting. Actually, there was a sort of a steepener there indicating that the yield curve was feeling a bit more pain in the 3-year, between the 2-year. And then if we go to the twos to fives curves, we see that that too on Friday steepened a little bit. So the point is here is that I think the market is saying, okay, the Fed will probably do not much at all. I think the bar to hike is quite high at this point. I think what would it take for the Fed to hike over the next few months? We'd probably have to see multiple months of very high CPI readings. Would have to see multiple months of unemployment rate coming down, employment remaining very strong, maybe some other stuff with geopolitics, Trump's potential policies, etc. So that's where we're at. Now, what does that all mean? At a certain point, we have the equity risk premium. So we now have a sort of going down. What it basically means now also is that the yields on is starting to pick up quite a lot. And we can also see that the real yields are actually doing are quite elevated at this point. So again, let's just go back. I think I've got a chart here of the real yield. Yeah, so this is the 10-year real yield. And what you guys can observe, I hope we can see it. Oh, that's a very short-term one. Let me put that on a daily, let's say 3 months. So this is the real yield. So this is the amount of real return investors are getting on a 10-year once inflation is accounted for. And what you can see here is that that's actually has gone up, quite a lot even since December. And at the moment, it's still just grinding upwards a little bit. And it's now at quite an interesting level, 2.3%. And if we just actually go back quite a long time, if we go back, let's say 5 years, you can see we're now getting to levels which are, historically quite interesting. So it seems to me that really what's happening here is that, the real yield is relatively high, is relatively attractive. The question is, can that go up a little bit more? And as that keeps on going up, that will eventually cause some kind of bleeding of money over into the stock market. And I think because the point is that stocks, at a certain point 2 or 3 years ago, Tina, there is no alternative to stocks. But what we're now starting to see is that real yields are providing, a real yield and an interesting real yield. And that's starting to be reflected that stocks are starting to feel a little bit of pressure. And you can see here, this is on the daily chart, the ES futures. You can see here that they are under pressure. Now, if we just throw in a few moving averages here, let's put on the exponential moving average EMAs, you can see that we've actually, as we speak here on Monday morning, we've broken down below the 100-day. You can see that this 20-day moving average, which has essentially been above the 50 for a long, long time, you can see that that's starting to roll over, and we're definitely starting to get a bit of a toppy formation here. Now, there's no need to sort of think that everything's over. We can take a fib here, and we can see that we're not even on this longer term fib here. We're not even down to the 38. But you've got to say that the 38% fib is starting to get interesting, something like 5760, let's call it 5760. And there's a bit of horizontal resort here on the ES at about 5720. So I think that zone here is going to be fairly key, and you'd want to see that hold. Now, if we go back longer term, there's not enormous amount of technical damage done. So let's all put this into context. But definitely the market is moving a little bit of momentum. And I think that what we could be seeing is a little bit of money just slowly shifting out of the equity space, perhaps into the bond space. But my personal view is that probably on the real yields, you have another maybe 10 or 15 or 20 basis points as a safety valve, which needs to go up. And I think that bonds, for example, would not be a buy. The long bonds were not an active buy until we have the real yields really getting up to about that 2.7, 2.75%. So we've still got a little bit of room to go. But certainly the equities here, we also see NASDAQ, similar kind of situation. NASDAQ here on the 100-day EMA on the futures. at a pretty key level there. And something else we need to be looking out for, you can see that the Russell is very, very weak. So that's now down below the 200-day EMA. We can see the equal weight, the RSP, is almost at the 200 EMA. And we can see that the Mag 7s as well, this is Mag 7 ETF here, not as weak as the equal weight or the Russell, but definitely starting to get a little bit toppy. Having said that, again, I repeat, we're just getting now on the Mag 7 ETF. We are at a 61.8 fib retracement here. So, which also coincides with the 50-day moving average. Could we get a bounce? It'd be interesting to see. Maybe the bank earnings will be strong. We shall see. We also might get the yields are sort of coming off a little bit. But just having a look at the yields, which are, let's have a look. Where are they? They are here. We can see that the yields here are getting to levels where, we have quite a lot of hawkishness priced in. This is the 2-year, which I just discussed. As I say, we've gone from sort of 10 cuts down to about just over 1 cut for 2025. If we look at, let's say, the 10-year, we can see that has obviously gone up a lot. So the question now is, could it get up to the 5% or even just sort of retest the recent high of about 5.01%? It seems to me that, the market likes a magnet, and that would be a very good possibility, which would also coincide with a slightly higher real yield. And I think once we get up to that point there, we could really see some real pain and maybe a further sell-off in equities. And if you look at the 30-year yield here, you can see that it actually touched 5%, I think, on Friday. And so again, I think that could possibly go up to about, about 5.15 or so. So I think there's still a little more room to go. Although, of course, the big thing which is going to decide this most probably is going to be on Wednesday. We have the CPI, we also have the PPI, but we have the CPI. If the CPI comes in sort of hotter than expected, higher than expected, I think we could get a final sort of blow off in the all across the yield curve, but especially, let's say, in the 10s and the 30s. That would coincide with some higher real yields as well. And I think at that point, we would start to get a little bit of a shift then from the equities over into stocks, just a little bit of reallocation, which in theory should cause some downward pressure on stocks. On the other hand, if the CPI comes in sort of soft or much softer than expectations, maybe that could be a cause for a rally. So it's difficult to say. One thing I would look at is just the ratios here. I do like to look at the ratios. I think I talked about it last time. SPY TLT, as you guys can see, this has been absolutely in favor of SPY over TLT for a long, long time. But what we are starting to see is definitely a sort of a bit of a topping formation, a little bit of resistance, and even some red candles. So that's SPY versus TLT. So what you can start to see here is that people are maybe starting to think, is it time to shift some money into the bonds? We can see that the SPY, even against the equal weight, is coming off. We could see, let's say, for example, the Qs, the QQQs versus the TLT, definitely starting to sort of come off a little bit. And something which I like to look at is the totality of the stock market, ITOP versus totality of bonds, which is GOVT government. And you can see that also is kind of topping out. So the point here is that really what the market is trying to figure out is, okay, these yields have gone up a lot. The term premium has gone up. Real yields have gone up a lot. Inflation expectations are going up a little bit. Of course, on Friday, we had the University of Michigan, but I don't know how much we can, which was a little bit hot. Those inflation expectations were revised upwards. But that is a notoriously, it's a consumer number which, has no predictive value really. But definitely what seems to be happening is that the market is having a bit of a rethink. And essentially, we're going to have to see what happens to the real economy over the next few months. If it remains hot, definitely, I think the yields on the long-term bonds will go up enough, and the real yields will go up enough to start making stocks less attractive. So earnings are going to be very important, and obviously the earnings season is going to be important, which is starting to happen, and of course the CPI. But let's just move on quickly to a couple of other things, guys. Don't want to make this too long on this first day here. So what is kind of interesting as well is oil. Oil is having a very good moment here. It has reached a bit of resistance. Some of this was probably short covering, but the reality is that Biden has left a little gift to the incoming Trump administration by putting on some pretty significant tariffs on about 200 players in the Russian oil space, oil tankers, insurers, refiners, the Indian refiners. So there could be, doing quite a lot of research. A lot of people are saying that, the physical reality is that not that much oil will be taken off the market. But the reality is, who knows, maybe Trump is going to impose more severe restrictions on oil supplies from Iran. And this, very last minute sort of Biden oil not to say tariffs, but restrictions, punishments could bite in a little bit. And so we've seen that oil's had a bit of a bounce. So we see that reflected, for example, just want to look at just a couple of things here. We can see that, for example, the ratio here, just found this. This is the premium of calls over puts. So this is the skew on the calls puts. And as you can see, that's gone up quite a lot. So definitely the market quite bullish at the moment. But my personal view is that in the absence of any more sort of new news, so to speak, I think, we might start to get a little bit of resistance here. But having said that, the time spreads, this is December 25, December 26, pretty strong. But again, you can see that, we had a nice breakout, but we are now starting to get up to a bit of resistance here at around about $4 and even $4.30 on December Z5, Z6 contracts. So that's something which could start to get a little bit of resistance. Just while we're talking about nat gas, kind of sort of energy rather, let's just have a think about nat gas. Sort of interesting just to see some of the weather forecasts. And so just looking at the weather forecasts over the week, and you see here the 6 to 10 day temperature outlook. So that was revised from Saturday into Sunday yesterday. So this is yesterday's forecast. You see this much colder, below average weather conditions sweeping across to the highly populated northeast of the US. And we can also see on just a different map, you see that here is very, very cold weather. And nat gas, of course, loves very hot weather in the summer and very cold weather in the winter. So what we're seeing here is that the heating day degree, so the number of heating days requiring significant heating. This is kind of interesting, give you a bit of perspective. And again, this is in the context of the nat gas market. You can see this is here where we are, 2025. And you can see we're up to 1,007 here. This is the values, just an adjusted value. And you can see here, this is the 30-year normal is 933 and the 10-year normal 887. So interestingly enough, for the first time in a few years, we're actually sort of, actually quite a high level here. And so this is, potentially quite bullish for nat gas, or has been bullish for nat gas, this, having a relatively cold winter. And of course, we're having a cold winter over in Europe as well. So if we actually look at nat gas, no surprises there that nat gas has actually broken out a little bit. But the question now is, and inventories are coming down. So it's going to be interesting just having a bit of a red candle today, because maybe it's gone a little bit too far. So just keep your eye on the inventories coming later this week on nat gas on Thursday morning, normally at 11 o'clock from memory. If that shows a significant drawdown, there could be, on any dip here, there could be a bit more sort of upside for nat gas. But you also need to be keeping your eye on the weather, of course. Another thing which is interesting, as I say, this evening we had the speech by a prominent member of the BOJ, Hishino, I think later on tonight. So let's just look at, we know that the dollar has really broken out strongly, just on the back of, generally strong economic strength, and also, of course, the non-farm payrolls. So it's interesting to see here the dollar, how further it can go. I mean, I can't really see any reason for the dollar not to keep on going, apart from sort of, technicals. It is overbought in theory, RSI, all this kind of stuff. But the reality is you see the euro absolutely being sort of killed this morning. You can see that the pound is being killed. We see the pound gilts is going up, and there's really a sense there that the gilt market is not proving to be attractive to buyers of bonds here. So we see the pound down, the euro down, the Swiss franc, also very, very weak. We can see the Aussie is down, the New Zealand dollar. We can see the Canadian dollar kind of trading in a range now. But there's what we have for Canada, of course. We had very strong numbers on Friday for Canada. So that was interesting, very strong payroll numbers. But of course, we have the threat of Trump, who in theory is being inaugurated in about, 8, 9, 10 days, I think on the 20th. And in theory is threatening on day one, very serious tariffs against not only sort of China and Mexico and Europe, but also Canada. So it's going to be interesting to see what happens to the Canadian dollar. But what I want just to talk about here is the Japanese yen. And you can see here that the yen, this is USD yen. So you see the USD is very, very, very strong here. So really the puzzle piece is whether this speech tonight by Hishino will be a way of preparing the market for hikes or not. Now, of course, if that is hawkish, we could see the US dollar pulling back. But if he sort of generally sort of repeats what Ueda, the governor, said about a week ago or so, saying that there was maybe no urgency for a hike, we could see further upside and may even come up and test this 161 level. And just keep an eye, guys, on the BOJ, just what is being priced in at the moment, if I can find it. So if we go on for Japan, just have a look here. Yeah, so you can see here for the meeting, which is coming up on the 24th, so about 9 days away. Really, it's a 50%. It's a coin cost at this point. So the market's pricing in 12 basis points, so out of 25 for a hike. It's literally 50-50. So just keep in mind the speech tonight, because if the BOJ wants to signal to the market that a hike is coming, this would be an excellent opportunity. He's speaking, I believe, to a regional conference in Kanagawa province. So that's interesting. It could be some action. Now, if that happens, we could see further upward pressure on Japanese yields, which of course will be it's one of the largest bond markets in the world. So that could be reflected in higher yields globally. Okay, so apart from that, guys, I might end it there because it's gone on a little bit long. I just want to see if there's anything else I wanted to chat about. Gold's coming off a little bit today. Yeah, so that's it. I'll leave it there. But obviously, just we have to be keeping an eye on the curve to see if it's steepening. Be curious to keep an eye on the Japanese yen overnight. Obviously, the yields. I just wonder if we have any Fed speakers. I know we have some Fed speakers this week, but I'm just going to double check quickly and see if there's any Fed speakers today. Because really, what's going to be quite interesting is to see if just the reaction to the strong data which we had last Friday. So let me just quickly look here and see central banks. We have Schmidt talking. Actually, that's tomorrow. So we don't have any Fed. So we have Williams and Smith tomorrow. So that Williams is going to be interesting. Always going to be interesting. Barkin, Kashkari, Williams. So we have a few Fed speakers here, as you can see. Okay, guys, I will leave it there because it's running late. I'll post this. Have a great day, and we shall be talking soon and regularly, I hope. Thank you.